Hi everybody, Luke Gromen, FFTT. Hope you're well. Hope you had a great weekend. I know we did here. Beautiful weather. So it's getting into the transition to late summer. So beautiful long days. They're shortening up a little bit. So hope you're making the most of it. I know we are. So with that, I'm going to jump in. Thank you as always for submitting questions. Really appreciate it. Really helps me learn a lot. Helps me think about things differently. So I really appreciate you. A few questions here. First, from Dean. With interest rates having risen at such an unprecedented rate of change, so high, so fast, why is it that we aren't seeing bigger things than some regional banks breaking in credit markets? I think it's partly a function of timing. From what I've seen, a lot of the U.S. corporate sector has locked in and refinanced, termed out their debt over the last several years. Households in mortgages in particular have in the U.S. in particular have locked in for long rates at fixed rates, or for long terms at fixed rates, excuse me. Banks, we've seen they've struggled a bit, but here too, we've had the Fed with some of their facilities ease that stress. U.S. debt ceiling, I think, curtailed the amount of issuance in the second quarter. We're starting to see that resume now, especially with yesterday's monstrous 3Q and 4Q Treasury issuance numbers that they just laid out. So that may destabilize things a bit. We still have commercial real estate, I think, resets largely on the come. So that's what I also refer to in terms of timing. And then I think critically, this fiscal dominance concept that myself and a number of others have been increasingly highlighting as we've moved through this year. There is a tipping point that you reach with debt and deficit levels this high where raising rates starts to become stimulative rather than contractive. So I think we're already on the wrong side of that. In other words, I think we're already in fiscal dominance. So the bigger U.S. deficits get, that's going to increasingly offset the restrictive implications or restrictive impacts of Fed policy. The other issue is that with debt levels as high, you get very binary outcomes. If the Fed wanted to stop inflation, get it back to their targets right away, remember I've been saying for a while, they're not operating a dial, they're operating a switch because there's so much leverage in the system. The Fed could have stood aside in March. They could have said unsecured depositors lose all their money. Venture capital firms with a couple billion in deposits, unguaranteed, uninsured, sorry, you lose that money. Yes, you need to wind down your investments. Yes, you need to lay off people. Yes, your companies need to close, so on and so forth, or have that ripple through the economy. The Fed did not do that. And by definition, that's inflationary. We had a deflationary or inflation. They had one of two options. There's no middle ground with leverage is high, and they chose inflation. So the final part on timing is that the fuse on government borrowing, in particular U.S. government borrowing, and the impacts of a debt issue, credit issue are far longer. And like I just said, these massive new borrowing estimates for 3Q and 4Q of this year, calendar 3Q and 4Q, may start to reintroduce some instability going forward. So let's watch and see. From James, I really liked your points recently on a guest spot you did about how logically the outcome of today's current financial environment is a choice, in the U.S. at least, depression versus inflation, and that inflation is the obvious choice those in power will make. Do you see this being more regional, domestic, global, etc., or pretty ubiquitous? All of your advice about being unleveraged with cash on the sidelines in gold and Bitcoin, is that for some prospective plunge in asset prices, which is then followed by runaway inflation in which you buy things are crashing? Barring an energy productivity miracle, I think we're likely to see a global secular high rate of inflation. I don't think it's necessarily runaway inflation, but that is actually on the menu of options depending on what policymakers do and what happens with events, just given the situation. But it's not my base case of runaway inflation. But I do think secular, much higher inflation than people are used to, that is my base case. I think the effects, and the reason I think that, let me say, is because the post-$71 system is a global system. And the issue is with the dollar system, if you have a dollar inflation, you're going to have inflation everywhere. Now, the effects of that inflation, I think, will vary regionally and can be oversimplified down to commodity exporters and industrial output will close the wealth and income gap with financial assets and financial debtors. Yes, in terms of why do I have the cash on the sidelines and recommend being unlevered on holdings, I've got the reason I say that is I've got high conviction. I have high conviction in the end game, how this plays out. I have extremely low conviction in the path between here and there. And the pathway from here to there is extremely political. So an extremely political situation can be an extremely irrational situation. And so I don't want to be levered. I don't want to be over my skis too far when I'm reliant on politicians to be rational. To do so. So from Gary, Blake, David, and a couple others, please talk about the macro implications of the Japanese adjustment to yield curve control. What did they really change, and what is it? And does it matter if they're already back to buying bonds aggressively at higher yields? What does it mean for U.S. markets specifically? All else equal, to me, it repatriates Japanese capital globally back to Japan and raises the global cost of capital, or yields, for global bond markets. That Japan already was back in buying some tells me to basically manage the rate at which yields go up. To me, is a sign of how fragile the entire system is, how untenable the whole situation is, and a symptom of how fast policymakers will react. So there's still some of those saying, well, I'm just going to... To me, it speaks to the point of needing to be there, not be all in cash, not be... Because people say, I'll be all in cash, I'll be all conservative, and I'll move when they move. Well, they policymakers are showing repeatedly to be proactive, to be aggressive, to respond very, very fast. So I think that is important to factor into calculus as we're thinking about just our allocations ahead of any potential issues. In terms of Japan buying, the only thing I'll say, I think it's I'll say two things. I think it's a managing of rates higher, number one, but historically Japan buying bonds has been good for global liquidity. So there's a little bit of a yin and a yang, right, in terms of if Japan's managing the process by injecting more liquidity, that's good for liquidity, but all else equal, the fact that they are widening it out, that yields are rising there, raises the cost of capital and yields around the world, which is bad for liquidity. So ultimately, I think it's a bit of a destabilizing factor from a period of relative stability over the last several months. From Vinny. Could the recent superconductor discovery possibly be one of the energy miracles you refer to? How would this affect your theory, even if commercialization is 3 to 5 years out? Yes, if this is what it says it is, absolutely, it could be an energy productivity miracle. With that said, the commercialization, if it's 3 to 5 years out, that's too long. They're not going to make it in time. It's not going to arrive in time before the U.S. needs to resume QE or yield curve control to ameliorate fiscal problems. It needs to be commercialized way sooner if it is to have the effect to completely force me to change my views on the acuteness of the U.S. and Western fiscal strains. I think it also raises other issues. We saw that China, I guess today the news is China replicated the experiment, if I read it correctly. If that's the case, what does it do to geopolitical balances of power if China is able to have this as fast as or faster than the U.S.? Am I to trust videos I see out of China? Because doing so in the last 3 years has not always been a good course of action to take, and I'll leave it at that. What does it do to global power dynamics? So it taken at face value, at the fastest possible commercialization, it would force me to completely rethink the fiscal strains. Anything less than that, and in particular the timing, it's not going to arrive in time. So let's watch and see the timing and how things develop on it from here. But it could absolutely be a game changer. From Stephen. You mentioned quite a while ago that maybe the Fed rate increases were to crush the world, but you couldn't seem to square that circle because a global recession would hurt the U.S. as well. But with how things have progressed, it looks like global weakness is driving capital to the U.S., and nobody seems to care that the rate increases have blown the lid off the deficit. So do you think the Fed might just keep raising rates to keep crushing the world, which might lessen the energy squeeze to keep attracting capital to the U.S.? I agree that on net capital has flowed to the U.S. And that nobody seems to care about the deficit yet. But keep in mind, we just had a debt ceiling where there was no issuance. And I think we might have just taken the lid off of that Pandora's box with this issuance number for 3Q, 4Q. These numbers are enormous. I think they'll probably be destabilizing. I think the bigger issue, too, is this gambit that the U.S. ran had a finite shelf life. The gambit was raise rates and release the SPR, get oil down, get inflation down, get the dollar up, get rates up. And the bet was basically that Russia and China will break before U.S. allies and the U.S. banking system and U.S. shale production rolled over. Fast forward to today, we saw the U.K. gilt market have its issues in the 3Q22. We saw the U.S. banks have their issue in 1Q23, and the Fed have to respond. And now we're seeing U.S. shale production roll over. If the U.S. keeps hiking, U.S. shale will roll over hard. And if it rolls over hard, U.S. loses control of inflation. They lose control of energy. They basically cede control of energy markets to Russia and to Saudi. If you lose control of energy, you lose control of inflation. You lose control of inflation, you lose control of rates. And then you're going to start seeing capital move out of the U.S. into commodities. And we don't do so well when capital is flowing into commodities. We like negative real rate tech things. We do really well when capital is flowing into that. Bonds, tech. When commodities are surging, money's going to be out of bonds and out of tech into commodities. And then we're going to be in a bit of a pickle because we've already run down the SPR. Shale, having peaked, will be several years in coming until it can resume prior highs. So when it is too early to say that the gambit worked. In fact, the gambit had a finite shelf life, and it's looking like it worked for that finite shelf life, but it now looks like that finite shelf life is ending. From FF, how would gold asset settlement work under BRICS and beyond with a lack of counterparty trust? Bretton Woods blew apart when the gold pool failed, and then USA defaulted on delivery. How do you envision enforcement working here? Pretty straightforward. No gold, no oil. In other words, you miss a gold delivery to a Russia, an Iran, a Saudi, the next oil delivery doesn't come, and you can deal with the consequences of oil shortages, gasoline shortages, economic disruption, political disruption, etc. So you better get the gold there. So I think that's how it will work. We spend a lot of energy in this country shuttling bottled water back and forth. I think you'll see. I don't think it's a stretch to see a system where you'll see energy expended to shuttle gold back and forth, at least on an intermediate basis. Maybe it's every quarter, maybe it's every month. After World War II, the U.S. was sending gold discs minted specifically for the Saudis as payment for oil. So I think that's where this is going at some point, probably not too far down the road. And then the final question from NP, what are your thoughts on Europe getting hit left, right, and center? Does not look good from an energy and industry and supply chains perspective. Second derivative probably means it does not look good for the U.S. and global rules-based order. Are you getting worried? I wouldn't say worried. I would say surprised. I've been probably one of the biggest surprises to me over the last 18 months has been how Europe has been essentially willing to commit economic suicide to respond to the Ukrainian situation. I would also say, to the extent the U.S. policymakers have encouraged Europe to take these actions, it is short-sighted, in my view, from U.S. policymakers. Your closest allies, the UK, the EU, are getting hurt worse than Russia or China are. And that seems like a strange strategy to me. It would be akin to, if we are to take at face value, take that with a grain of salt, if we're to take at face value U.S. policy admonitions that Putin or Xi or like Hitler or whatever pre-World War II, then what we just did over the last 18 months was akin to bombing the UK and France in 1940 to soften them up for Hitler. So the whole strategy to me of the last 18 months was very much in line with that finite life gambit I referred to earlier. There was basically a short-term policy set rolled out that had a finite life, and the gambit was basically Russia and China would fold before that gambit ran out of shelf life. And across the board, it looks like Russia and China have not folded before we've run out of shelf life on that gambit. And that means don't be surprised if you see oil prices rise potentially meaningfully in the second half of this year with very limited Western ability to do much about it. And then if we have a cold winter in Europe, Katie bar the door. Things could get really ugly. So let's watch and see. In the meantime, that's it for today. I appreciate everyone joining me. As always, if you like these updates, check out FFTT-LLC.com for more information about what we're up to, more information about our tree rings product, 10 most interesting things, brief synopsis on what grabbed our attention about them, whether they confirmed or refuted a way we'd previously been thinking about the world. Get a lot of great feedback on it. And as always, everybody have a great week. I look forward to chatting with you soon. Take care, everyone.